TSMC reported a 77% jump in net profit on July 16th. Revenue of $40.2 billion at the very top of their guidance range. Full-year growth outlook raised to above 40%, an additional $100 billion committed to U.S. manufacturing, one of the strongest quarterly earnings reports in the history of the semiconductor industry. The stock fell 5%. That is the story, not the earnings. The reaction to the earnings and the reason TSMC fell on numbers that would make most companies pop champagne tells you something important about where the AI trade actually is right now, not where the headlines say it is. Most people who follow markets know the name NVIDIA. Fewer understand that NVIDIA cannot ship a single chip without TSMC. TSMC is a contract manufacturer. They do not design chips. They build them. NVIDIA designs the GPU. Apple designs the iPhone processor. AMD designs its data center chips. Then every single one of those companies walks into TSMC's factories in Taiwan and says, "Build this for us." There is no real alternative at the leading edge. Samsung tries. Intel has been trying for years. Neither has closed the gap, which means TSMC's revenue is a near-perfect proxy for actual AI chip demand, not projected demand, not analyst estimates, real orders placed by real companies requiring real manufacturing capacity. When TSMC reports, the number is not a forecast, it is a receipt, and the receipt for Q2 2026 was $40.2 billion, up 33.7% year over year. Gross margin of 67.7%, a record, beating even their own guidance. Net profit up 77.4% to approximately $22 billion. By every conventional measure, that is a blowout quarter. So why did it fall? Two reasons, and they are connected first. TSMC raised its full-year capital expenditure guidance from $52 to $56 billion to $60 to $64 billion. That is a roughly 15% increase in planned spending, on top of a year where they were already spending more than any chipmaker in history. They also announced an additional $100 billion committed to Arizona manufacturing. That brings their total U.S. investment commitment to $265 billion, the largest foreign direct investment in U.S. history. Second, Q3 gross margin guidance came in at 65 to 67%. That is below the 67.7% they just posted in Q2. The reason is the ramp of 2-nanometer production, the newest and most advanced chip manufacturing process in the world, which is expensive to start up, and compresses margins in the early quarters before volume scales. Put those two together, higher spending and lower near-term margins, and you get what traders called a beat and worry session. The backward-looking numbers were perfect. The forward-looking numbers introduced a cost the market had not fully priced. A JP Morgan equity trader commented on the day that the sell-off was, and this is a direct quote, "Hard to pinpoint as a specific reason. There's no real negative news. I think it just shows how elevated the bar has gotten for semis given the past few months of outperformance." That sentence is worth reading twice. The bar got so high that a record quarter was not enough. 2 weeks ago, semiconductor stocks had one of their worst sessions in years. Micron fell 13%, Applied Materials fell 10%, the SOX index lost 6.7% in a single day, wiping out an estimated $1.3 to $1.4 trillion in market value.